You're going to work for about 40 years. You will wake up Monday through Friday, drink your coffee, sit in traffic, and trade the best hours of your life for a salary. You will do this for 4 decades. And then, if you are like 95% of the people on this planet, you will arrive at the end of that road with almost nothing to show for it. That is not an insult. That is a statistic. And statistics do not care about your feelings. The Federal Reserve Survey of Consumer Finances found that the median American household approaching retirement age has less than $250,000 saved. After 40 years of work, that sounds like a lot until you run the numbers. At a safe withdrawal rate of 4%, that gives you $10,000 a year. That is $833 a month. That is not retirement. That is survival. And Boris is here to make sure you understand exactly why this happens and exactly how to make sure it does not happen to you. Let us start at the beginning, with the biggest lie you were ever told. You were told that if you work hard, save a little, and live within your means, everything will be fine. Your parents told you this. Your teachers told you this. The system was designed to tell you this. And it is not exactly wrong. It is just dangerously incomplete. Because working hard and saving a little, without a strategy, without an understanding of how money actually moves and compounds and grows, will get you to retirement age with a number in your account that will terrify you. Hard work is necessary. It is just not sufficient. Here is what nobody told you. Money has a behavior. It does not sit still. It either grows or it shrinks. It either works for you or it works against you. Every single dollar you own is always doing one of those two things, whether you are paying attention or not. The 95% are not broke because they are lazy or stupid. They are broke because they never learned to make their money work. They spent 40 years working for their money instead of making their money work for them. That one distinction is the entire difference between the 5% and everyone else. Let us talk about the weapon that separates them. Its name is compound interest, and it is the most powerful force in the financial universe. Albert Einstein, yes, that Einstein, allegedly called it the eighth wonder of the world. Whether he actually said it is debated. But the math behind it is not debated at all, and it will change the way you see every financial decision you make for the rest of your life. Here's how it works. You invest $1,000. It earns 10% in a year. Now you have $1,100. Next year, that $1,100 earns 10%. Now you have $1,210. You did not add any new money. The money you already had made more money. And then that new money started making money. This is compounding. It sounds simple. It does not feel simple until you see what happens over time. That $1,000 invested at 10% for 40 years becomes $45,259. You put in $1,000. You get back 45 times what you put in. You did nothing. Time did the work. Now here is the brutal part. If you wait just 10 years to start, if you are 25 instead of 15, or 35 instead of 25, that same $1,000 only becomes $17,449. You lose more than $27,000 by waiting 1 decade. Not because you invested less money, because you gave compound interest 10 fewer years to work. The most expensive thing in personal finance is not a bad investment. It is waiting to invest at all. The researcher Jeremy Siegel spent decades analyzing stock market returns in his landmark work Stocks for the Long Run and found that over any 30-year period in American history, the stock market has never produced a negative return. Never. Including through world wars, depressions, crashes, and crises. Over long enough timelines, the market always goes up. This is not investment advice. This is a historical fact. And the 95% who retire broke mostly ignored it. Not out of stupidity, but because nobody sat them down and explained it clearly. So why do so many people still get it wrong? Why does the knowledge exist and the results stay terrible? Because knowing something and doing something are separated by one thing: behavior. And human financial behavior is almost perfectly designed to destroy wealth. The economist Richard Thaler won the Nobel Prize in Economics in 2017 for his work on behavioral economics, the study of why people make irrational financial decisions even when they know better. What Thaler and his colleagues found is that human beings are wired for short-term thinking. Your brain was built by evolution to solve immediate problems: find food, avoid the predator, survive this winter. It was not built to think about what happens in 30 years. Retirement is 30 years away. The new car, the vacation, the bigger apartment, those are right now. And your brain, no matter how smart you are, will consistently and predictably choose right now over 30 years from now unless you build systems that force it to do otherwise. This is the trap. You get a raise, you upgrade your lifestyle. You pay off one credit card, you open another. You tell yourself you will start saving seriously next year when things settle down. But things never settle down. And next year becomes next year becomes next year until you are 58 years old and the number in your retirement account does not cover 2 years of expenses. This pattern even has a name: lifestyle inflation. Every time your income goes up, your spending goes up to match it or exceed it. You never actually get ahead because the goalpost of enough keeps moving. The people in the 5% figured out how to stop this. Not by being extreme, not by living on rice and refusing to enjoy their lives, but by automating their savings before lifestyle inflation can get its hands on the money. Here is the principle: pay yourself first. Before you pay rent, before you pay utilities, before you buy groceries, a percentage of every paycheck you receive goes directly into an investment account, automatically, without you seeing it, without you making a decision about it. The behavioral economists call this a commitment device. You are removing the moment of choice, the moment where your brain can talk you out of it, and replacing it with a system that acts on your behalf. David Bach, the financial educator who wrote The Automatic Millionaire, tracked hundreds of ordinary middle-class Americans who retired wealthy and found that almost all of them shared this one habit. Not exceptional income, not perfect market timing, just automation. The money moved before they could spend it. The number does not have to be large to start. If you are 25 years old and you invest just $300 a month into an index fund tracking the broad market, with an average historical return of 10%, you will have approximately $1.9 million by age 65. Not $250,000. Not $500,000. $1.9 million. From $300 a month. That is $300. That is not an exotic strategy. That is not a secret known only to the wealthy. That is arithmetic available to anyone willing to run the numbers. But here is where the 5% separate themselves even further. They do not just save. They understand the difference between an asset and a liability, and they build a life that acquires assets and minimizes liabilities. The investor Robert Kiyosaki made this distinction famous in Rich Dad, Poor Dad, though the underlying principle predates that book by centuries. An asset puts money into your pocket. A liability takes money out. Your paycheck is not an asset. Your paycheck is income. The investments that your paycheck funds, the index funds, the real estate, the ownership stakes in companies, those are assets. And the 95% spend their entire lives consuming liabilities while the 5% quietly accumulate assets. This is why the rich seem to get richer automatically. It is not luck. It is not inheritance, though that helps some. It is that they passed a tipping point where their assets produce more income than their lifestyle costs. Once you reach that point, you are no longer dependent on trading your time for money. The assets do the work. Your time becomes yours. Now, what does this mean for you, specifically, starting where you are right now? It means the single most important financial decision you will make this year is not which stock to buy or which cryptocurrency will moon. It is deciding what percentage of your income you will invest automatically, starting this month, without ever touching it again until you are ready to retire. Everything else, the tactics, the specific vehicles, the optimization, comes after that. The foundation is the habit. The system comes before the strategy. If you are in debt, that changes the order of operations slightly, but it does not change the principle. High-interest debt, particularly credit card debt charging 20% or more annually, is a guaranteed negative return on your money. Paying that off first is itself a 20% guaranteed return. Nothing in the market reliably beats that. So you clear the high-interest debt, you build a small emergency fund, and then you automate your investments. In that order. That is the framework. That is what the 5% did, most of them without anyone famous explaining it to them. They just figured it out early enough that time could do the work. You still have time. The question is whether you will use it. In 40 years, you will arrive at the end of the road. Everyone does. The only question is what is waiting for you when you get there. The 95% arrive exhausted, with a number that will not carry them through the years ahead. The 5% arrive with assets that have been compounding quietly in the background for decades. Assets that now generate more income every year than the salary those people used to earn. You were going to work for about 40 years. You already knew that part. What you decide to do with the money from those years, that is the only question that actually matters.